Hey, everybody. Welcome to the weekly wrap-up. My name is Gareth Soloway, Chief Market Strategist here. Now, this week was a week where the markets were in grind mode. We had PPI one day. It was better than expected. The next day, CPI, a little bit hotter inflation, so worse than expected. Markets generally ignored that. The big news of the week was the Oracle earnings, where, again, they missed on earnings. They missed on revenue, but they gave such amazing guidance. They said it's going to be the best next 5 years ever, that the stock ripped up. And that was really our biggest gainer day going into later portions of the week. Now, a couple other things here. The big other news was the jobless claims number, which usually isn't a big deal, right? It's a number we get every week. It's how many people file for unemployment in the previous week. But this one jumped up about 30,000 from the previous week. And so all of a sudden, people are starting to say, oh, wait a minute, maybe the Fed can cut 50 basis points. Now, I don't think they're going to do that. And the Fed Funds Watch tool is not telling us they're going to do that. But that helped drive the sentiment that the markets can be bought. Now, a couple things that I'm seeing in the charts. Number one, we're at the high end of the range into resistance. So that's the first thing. This is going to be a big test next week. Number two, the markets went to sleep in the second portion of this week, especially today. Volume today on Friday was unbelievably light because everyone's now looking to next Wednesday when the Fed announces their first rate cut. Now, the thing that everyone's going to be paying attention to is, what does Jerome Powell say? So listen, no one's going to be surprised when the Fed cuts 25 basis points. Now, that's going to happen. It's basically like a 95% chance, which essentially in this game is a sure bet. But is he going to be dovish or hawkish? And my guess is he's going to be a little hawkish because that CPI data was definitely a little bit hotter than expected. And we now have stagflation. Stagflation, a weakening economy. You could see it with the labor numbers while inflation still inches up. And let's call a spade, folks. You had CPI this week coming in at 0.4%. Now, to get the yearly inflation number, if you stick with 0.4, you multiply that by 12. Look at what that inflation number is. I mean, that basically puts us at 4% inflation. Whatever happened to the Federal Reserve and wanting to get inflation to 2%? Oh, so now double is okay and they'll still cut rates? Apparently, it looks like that. So just be ready, folks, that again, next week will be interesting. One little tidbit is that historically, when the Fed starts to cut rates, the markets begin to decline. Let's go into the charts and take a look here. The S&P 500, look at this, guys. The levels just continue to blow me away. The trend lines, look at this. So we had our underbelly trend line, and look at how price behaved. Every time it hit it, it bounced, right? And then we had the high end of this trend line, which, by the way, goes back to 2023, October of 2023, then tags in August of 2024, and then becomes resistance tagging in July, then in August, and then here in September. And look at how yesterday we went right to that line, and the market tried to break above it today. And we're just about to close. We have about a minute and a half left in the trading day. And unless we get a mega surge at the end of the day, the S&P is not going to break above this. And that is the market, my friends, that is behaving and respecting a trend line. And when you see the market act like that, it tells you, it confirms that your line is significant, okay? And that you should use it going forward, both as resistance, but also to know when something breaks out or breaks down. And so again, technicians need to know these lines, and they need to see the market respecting them because it gives them that credence or confidence that it is a legitimate line, and that therefore we know when something breaks out or breaks below or above that level. All right, so that's where we are on the S&P. S&P, again, about 30 seconds from close. It looks like we're going to end down a whole 1.5 points on the S&P. That would be what I would call about as flat a day as anything. Turning to the Nasdaq. Now, the Nasdaq's actually having a good day. Interestingly enough, the last couple trading days, the Nasdaq has lagged the S&P. Today, it is slightly leading or taking kind of a leadership role. And so listen, what's interesting here, and think about this, right? So when you look at the QQQ chart and you put the S&P right next to it, right? We saw the S&P is up into resistance. Okay, so it should stall out, right? It should stall out. But when we look at the QQQ chart, is the QQQ Nasdaq 100, is it into resistance? Is it into its trend line yet? Look at this. It's not, right? And so which one would make sense? Would it make sense that the S&P leads today or that the Nasdaq does? Well, the S&P was into resistance, right? The S&P was into resistance right here, so it probably shouldn't lead. It should stall out, but the QQQ is not, and so it pushes higher. Isn't that amazing? To me, it is. And listen, maybe I'm just a nerding out over this, but again, even after 26 years of technical trading, stuff like this still just is so cool. Like it's so cool to see how the levels work and how that just alone, just the fact that the S&P was into resistance gave us kind of insight to say, well, then probably the Nasdaq, which isn't into resistance yet, should lead to the upside. And sure enough, up about 0.4, just over 0.4%. Okay, the dollar today. Nothing going on here, folks. The dollar has been about as boring as can be, but the bigger picture still brings up concern for me. And the concern on the US dollar is this underbelly trend line that goes back to 2008. Now, why is 2008 important? Well, number one, it was the lowest point on the US dollar basically in the last, 30, 40, 50 years, right? So that's significant. Number two, it was the beginning of the financial crisis, right? And so it has significance both because it's a multi-decade low and it's also a major cycle low or on the dollar based on the financial crisis. And so the idea here is very simple, is that what we have now is we have resistance on the dollar up here, right? So again, resistance on the dollar here that is now broken below and support just below. And the reason I'm bringing this to your attention is that if we ever do break below this orange line and start to go lower, that is a major breakdown in the dollar. Now, listen, when I say major, a lot of people jump to the conclusion of saying, oh, he's meaning the dollar is going to collapse. Like it's going to just, the dollar collapse. No, no, no. The dollar is not going to collapse, not at least in the near term. When and you can, by the way, reserve currencies. I mean, you go to England back, a few hundred years ago, or even less than that. They had a reserve. There's been different reserve currencies. Reserve currencies generally, because so many countries hold them, they don't have epic collapses. Now, what ends up happening is slowly people diversify away from reserve currencies into other things. And what are we seeing? Bitcoin and gold. In fact, Poland just announced, is it yesterday I saw this announcement, that they are going to make sure that 30% of their treasury is gold. All right. We've heard many other countries saying, hey, we're going to diversify into Bitcoin, gold and Bitcoin, right? We know China's buying massive amounts of gold. So yes, slowly the dollar will lose its reserve status, in my opinion, but it's not something that it's like, oh my goodness, it broke that line. We're going to have an epic crash in the dollar. And I always like to kind of make sure people understand that, because I think a lot of people hear like, oh, it breaks the trend line, therefore it collapses. That's not going to happen, or at least it's very unlikely that it would happen. All right. The US 10-year, the 10-year actually bounced today. So you see a lot of chop around this level. Again, notice how here we closed below, we got back above, closed below, we couldn't get above. Today, again, we couldn't get back above. That's showing a little relative weakness. But again, we still have not confirmed below this level. So it's not a confirmed breakdown below the US 10-year trend line here. And again, I point that out because it's so important when you're looking at charts to understand when it's a fake out potentially or a real breakout or breakdown. In this case, it is not confirmed yet to be a breakdown, and so you have to reserve judgment. Everyone wants to make these fast judgments like, oh, it's a breakdown, it's going to collapse, or oh, it's a breakout, it's going to rip. In reality, I found as a trader for 26 years now is that you have to really be sure. Otherwise, you end up getting chopped to death by the algorithms, right? The algorithms are looking for people to jump off sides, and then they're like, oh, thanks for the money. Oh, thanks for the money. Thanks for the money, and they just whip you out. And so I'd much rather take the more conservative approach and being like, okay, I know when it confirms a breakout or breakdown, the odds are now 70 to 80% that it's really a breakout or breakdown versus just guessing and being like, well, 50-50, so let's give it a roll. If I want 50-50 odds or thereabouts, I'm going to the casino with my buddies and we're just going to have fun. We're going to have some drinks and we're going to gamble. And I go in there knowing that I'm probably going to lose money. In the market, I don't want to lose money. I'm not getting free drinks from the market here. I want to actually focus and make money. Okay, so that's one of the things we want to focus on here. Now, Oracle. This is a great example, guys. Look at Oracle. This was a chart that when they came out with earnings, I came on here and I said, this move is beyond ridiculous. It is absolute peak insanity and bubble. And lo and behold, on the day of earnings, it goes to $345. It's now back to $292. Now, look at this. What's amazing about this is that if you take before earnings to where we are now it's only a 20% move. And I actually think it's going to come lower. All right. I think it actually comes, listen, it's going to have a bounce at some point because it's getting, in all fairness, it's down, $55 from the highs. That's a huge move. But in reality, support now is around 258 to 259. And we have gap fill down here at 241. So at some point, this fills the gap. By the way, one of the metrics that I've taught for years is that in general, if you look at all the gaps, the big gaps, we're not talking like, this stock closed here this day and it opened 2 pennies above the next day. When you have a big gap on a chart, like a stock closes at $20 and opens at like 24 the next day, the odds of that gap eventually filling, if you look at all the gaps that are like that, is about 80%. So gaps, what I always say is gaps are meant to be filled. They are generally filled. There's backfilling of these gaps. And so at some point, Oracle's coming all the way back down. I don't think it's going to go in a straight line because you will get buyers that were like, holy cow, look at that 40% move that it had the other day. And now it's pulled back and they're going to buy in, right? And shorts will eventually cover. Speaking of which, I had this trade with smart money stocks in my service as a swing trade. We had a small position going into earnings. We got crushed on it. But instead of exiting, I added. We got our average up, and today we exited half at break even, and now we're in the money on the trade. It just shows you how when you keep your position size small, you have maneuverability. And maneuverability is the one thing that a lot of newer investors, they don't understand. They go into trades thinking all they're focusing on, they got blinders on, right? And they're saying to themselves, this trade is going to be a no-brainer winner for me. And so I'm just, and when you think that way, when you think it's going to be an instant winner, well, of course you're going to put all your money in that trade. Like it's going to be an instant winner. But in reality, I've learned the hard way, right? I've learned the hard way that trades don't always go as you expect. And I think anyone who's traded more than a few times in their life understands that, right? I've taken my losses. I've taken my lumps. I've been punched in the face by the market. Like I've done all those things. And so what I've learned to do is say, all right, I like this chart setup, but I want to leave room in case it deviates from my plan because that does tend to happen sometimes. And that enables me then to have more winners and a higher win rate because of that. All right. Think about it like this. If you tie your legs together, right? Your legs, let's say you're running a race and someone ties your legs together and all you can do is hop. All of a sudden, everyone else is racing ahead. They don't have their legs tied together. You're tied. You're handcuffed. What are you going to do? How do you maneuver? You can't. You have no shot. You are done. The market has you by the you-know-what. And the key is, again, don't let the market control you. You need to control your investments. Huge rule right there. Huge rule. And this is the thing, folks. I speak from experience. Like I started out with, I saved up 10K and I went to a prop firm. They gave me 50K to trade with off that 10K. But when I lost, it was out of my 10K, right? I mean, so what did I do? I started trading, didn't know anything. Even the traders in the office, they weren't really that good. So it wasn't like they were teaching me anything. And it was all bad. And, like I was losing. Suffice it to say, my 10K went to 9K, went to 8K, went to 6K. And I basically had to work 3 side jobs just not because I was like saving money, but just because I had to replenish my trading account. And then I would lose more money. And then I'd continue to work. I basically just work side jobs to it's almost like a gamble, like filling my pocket back up or my account back up. Now, listen, over time, I was so dedicated. I was so focused that eventually I turned a corner once I started really learning. But I took lumps after lumps. And even when I was a profitable trader, even today, even in today's market, do I take my lumps? I do. The difference is my win rate is so high and I've learned these tactics, how to read charts, that I'm net green. I'm net profitable. But I remember those days. If you're sitting there and you're like, man, yeah, I had a down week this week or a down month, I remember it. I remember it vividly. And when you get hammered that much and punched in the face by the market, it literally stays with, like at some point, you remember that feeling and you don't want to feel that ever again. So keep driving, keep pushing. All right. I do these rants and I get off topic, but nonetheless, let's get back to the charts. All right. So Oracle, great pullback, guys. Down trading at 291 now. There may be day trades on Monday on this, but really at this point, you're looking for it. If it comes back to like 260, then you start accumulating on the long side for a bounce. All right, Tesla. We got to talk Tesla. Tesla ripping up for the second day in a row. Amazing move here. This is a chart where I gave you guys this many times over. I said, guys, you have a wedge pattern here. When this wedge was forming, even before the breakout, we talked about it. All right, wedge pattern forming. By the way, what else pattern is this? What type of pattern is this, guys? Cup and handle, right? I love it. I love it. I mean, again, remember, the charts speak to us. The question is, do you know the language of the charts? So imagine someone gives you a book and it's in a foreign text, and you're like, what the heck does this mean? That's how most people are with charts. But if you learn that language, then all of a sudden you're like, oh. So again, this is telling me that the probability favors a move in this direction. It's powerful. It is powerful. So keep learning, guys. All right. So Tesla breaks out. By the way, look at the classic retrace to the scene of the crime. Breaks out, confirms, retraces. Boom. That's your buy point. And up, and away. The question is, where is this going to go? I'm not sure how high it'll go before a pullback. It's getting a little short-term extended, but I do think you'll get a major pullback around 433 to 430, right up in this range. All right, you have this major pivot high right here. And then if you do a Fibonacci retrace, Fibonacci, I love Fibonacci. Fibonacci, look, the 786 fib is right at 430. So those two combinations are likely going to create a pretty big brick wall for Tesla. But great move on Tesla. Again, hey, man, listen, if they can get robots and all this other stuff, then yeah, the stock should go up. Granted, that's a pipe dream at this point, but listen, Elon Musk has accomplished many things in his life, so it wouldn't shock me to see him get there. Now, one setup here, guys. I'm loving this action. Look at this. This is the VXX or the VIX. So this is the VXX is the ETF that tracks the VIX. But this here, it was at 52-week lows, and all of a sudden, late in the day, look at the rip. That's telling me something. That's telling me get long volatility for next week. Whether it's for the Fed decision, I don't know. But something, big money knows something about next week, and they are buying protection here. So again, I'm just passing that along. Do I have a position in the VXX? I do, and it is pretty big. But again, I am looking for some sort of move up here on the VIX. And if we look at this, by the way, look at this chart on the VXX. And I love this. So it's almost like a mini bottoming tail right there. But look at what's so cool about this. Look at this, guys. You have this downsloping wedge pattern, right? What does this look like an inverse of? What does it look like an inverse of? Look at that. See that? That's pretty cool. It's literally like you could basically take that chart and just bring it up here, and it would if you just flipped it upside down, essentially it would look exactly like the S&P. And that basically just tells you that as the S&P has been grinding up, volatility's been being sucked out, but at some point volatility reemerges. And when it does, when you're this compressed on the VIX, when it's this low, it's usually with a bang. So be ready for that. Again, I don't know. I'm not going to pretend to know if it's Monday, Tuesday, or the Fed on Wednesday, or maybe not even on Wednesday. Maybe it's Thursday, but something is coming in the markets. Be ready for it next week. Something, again, is coming. All right. I don't want to make this too long, guys. So let's quickly take a look at a few other charts. Netflix broke down this week from a key trend line. Please note this. You have this nice little upsloping trend line here. It got almost below, and then they rallied. It opened below, got back to the line here, and then look, broke down, confirmed today. Now, listen, it doesn't mean it can't bounce a little bit, but this is now a bigger breakdown on Netflix to head lower. Bitcoin today, Bitcoin had a good move up. You guys remember the level that I gave you guys in my trading game plan? What was my upside target? You guys remember? 117,000, right? Remember the pivot point? When the pivot point broke, I said, here, and I'm going to put all these lines in for you guys. Okay, so here we go. This was your pivot line right here. I'm going to flip it to yellow, or yeah, we'll do yellow. Pivot line, we had the inverse head and shoulders. Pivot line here. Closed above. I said, guys, if it breaks above, it's going to go to 117,000. Today, the high, 116,833. Granted, I'm a little off, at least for now. I bet over the weekend it touches 117,000. Now, 117,000 is going to be resistance, right? Because what we can do is we extend this out here, and look, all of these lows here, and then this area here, and this high. So that's going to be resistance. Now, it's not to say Bitcoin can't get through that level, but I've always said to you guys, and I preach this because I have to listen to this myself, is that respect, support, and resistance until proven otherwise. So many of us are like, oh, but I love Bitcoin, so I think it's going to just blast right through. Okay, but notice the word I think. It's not data driven. I think isn't data driven. Data driven, you want to see it break before you say it essentially has or will. All right, very, very important there, guys. So many of us, especially, by the way, I was ranting about this morning, but social media is like the scourge of the world, in my opinion. It creates so much emotion, and emotion is what, honestly, institutions love from you guys. The more emotional you become, the more irrational your decisions. You'll chase it all-time highs. You'll buy it. You'll dump at crazy lows. And because you're seeing these people calling for these crazy price targets on everything. And you just want to be aware, if you can tame your emotions, you will be 100x better investor and trader. Truth right there. All right, gold today, flat to positive. The topping tail is still intact. This is another one where a lot of people are very bullish on gold, and I'm all for that. I'm mid to long term very bullish too. But in the short term, what does the topping tail mean? It's a bearish reversal signal. It also happened at the trend line. And so what I have to say here is, okay, well, this is a bearish reversal signal. So until this is negated, this is a bearish, you'd expect a downside. Now, can it be wrong and it can fail? Absolutely. But until it fails, until it proves to me that it fails, I can't assume that. Very simple. Silver pushing up. Go silver. Finally, bullish pattern starting to push up. First resistance is around 44 right up here. If it gets through 44, 48 to 50 is your likely target, but finally seeing some participation in silver. Oil real quick here, guys. Oil didn't do a whole lot today. Again, I have all the chart lines off the chart, but that's okay. Again, I could whip them up real fast here. There's that first line, and then we have our gap fill line down here. There you go. There's the lines that I have for you guys. Here's your support down here at gap fill, key gap fill consolidation, and then resistance right up here. But again, there's nothing on oil here. I mean, listen, if you're a hardcore scalper in oil, maybe. But aside from that, I'm a swing trader in oil. I really don't day trade oil, and there's nothing there. Natural gas, again, great example of how the rug can be pulled. You got above this level. People thought, oh, it's a breakout. I look at it, I say, but it hasn't confirmed yet. It is an unconfirmed breakout. And then what happens? Bloop, it comes right back down. Yes, I did say bloop. All right, so in any case, just be aware that just because you breach a level one way or the other does not necessarily mean that it is a true breakout or breakdown. The institutions and the algorithms know every button to press to get you to do the wrong thing at the wrong time. They are lurking like sharks in water with chum, right? And you're right in the mix. So learn the charts. It is the most liberating thing ever. It's amazing to get to a point, and I'll finish with this. I apologize, long weekly wrap up today, but some great stuff. But it's important to understand that we are at a disadvantage and we are exploited by big money institutions. They create trading programs on purpose to get you to get in. Have you guys noticed how like sometimes you'll buy and the second you buy, price drops, right? And you're like, what the heck? Like how does it fall like literally within 3 seconds and we get, there's algorithms. They do this. They know what buttons to push to trigger your emotion to get in. And by the way, I said this earlier in a different video, but please understand that when you're on like X or these social media places, half of the bots that are spewing like Bitcoin to 1 million or the S&P will never go down or whatever it is, they are bots that are programmed by institutions. They want you to, you're either exit liquidity. And so this is where charts can actually be so liberating where you don't even have to go on those. Who cares what those people are saying or those bots? They're not even people. Look at the chart. Now, I want to stress, the last thing I'll say, guys, I promise. The charts are not always right. All right? They are not. So you have to go into chart analysis accepting that it's a probability game. If you study them as well as I have for 26 years, I get to 70, 80, maybe 80% success rate. But that still means out of every 10 trades, I'm going to have 2 losers. That's okay. The numbers will work out. The numbers will work out when you get that good. And again, you start getting win rates like that, and you're on par with the institutions, maybe even better. All right. Go have an awesome weekend. Go reward yourselves. Go relax. Come back Monday, 9 a.m. with me for the My Trading Game Plan. Don't forget, Ben does his RSI trade of the day at 8:45 on the Verified. And by the way, My Trading Game Plan's not on my channel. It's on the Verified Investing channel, this channel. But Ben does his RSI trade of the day before the game plan. We're bringing more and more quality content that I actually believe in versus CNBC, Bloomberg, and all this other stuff, all the PE ratios and all this. Come on. Come check us out. Tell your friends, guys. Tell your friends. If this has made a difference for you, tell one friend this weekend to tune in on Monday. I will bring my A game and show you guys some amazing stuff. Have a great one. Thanks again, guys. Have a great weekend. Talk to you soon. Take care.